Well, it's the rally that just won't stop. The Dow, S&P 500, and NASDAQ surging to all-time highs, driven by a combination of earnings news and merger news. The session began benign enough after that October jobs report came in just below consensus. We did see a sharp decline in participation. The real unemployment rate, the U6, edged down to 7.9% from 8.3%. That's huge, in part because folks working part-time for economic reasons plunged from almost 370,000. Now we got 4.8 million of them. And by the way, this metric for the U6, the record low is 6.8% back in October of 2000. We also got the ISM report on the service economy. That came in at its highest level in 12 years. And midway through the session, Qualcomm began to surge on reports out of the Wall Street Journal that Broadcom was preparing a bid, perhaps around $70. I think that would be a real lowball number, but it does underscore that a lot of names out there in play. We're going to see a lot more merger mania. And then, of course, this earnings. We can't forget about that. Apple's big beat last night. Investors now okay with chasing names as long as they're providing strong financial guidance. By the way, this earnings season thus far has been pretty impressive. According to FactSet, 81% of S&P 500 names have reported. 66% have beat on sales. 74% have beat on earnings per share. Right now, your forward PE is 18. Yes, well above the 5-year average, was slightly above 15. Nowhere near levels generally associated with major market crashes. Still, though, heading into the weekend, many are fretting that maybe there's too much hysteria. Stocks are soaring. Valuations are outsized. There's a sense of complacency. And now merger mania. Here to discuss with me, Peter Schiff, CEO of Euro Pacific Capital. Peter, it's been too long. How you doing?
I'm good. How are you?
You look fantastic. You look tanned, rested, like the most interesting man in the world. But what about this market? How you feeling about it?
Well, look, I think it's a bubble. Doesn't mean it can't get any bigger. But, you mentioned the jobs market today. This is a continuation of the same weak employment trends that put Trump in the White House. Almost 1 million people left the labor force in October, third biggest exited ever. We have a new record for the number of Americans not in the labor force. Labor force participation dropped to 62.7. And then look at real hourly earnings actually went down. They had to round it up to get it to zero. So you have, I think, a third of the jobs created, a third were waiters and bartenders. And most of those are part-time jobs. So this is not a strong economy.
I like what I'm seeing, though, when I read these business reports, when I read these earnings reports, when I see durable goods, business investments coming on. So there does seem to be a disconnect with the official BLS report, but everything else, all the other evidence out there, whether you consider it soft data or hard data, points to an economy where the wheels of commerce are moving, maybe not as fast as you want them to move, but they're certainly moving in the right direction.
Well, I think there's a lot of optimism. Unfortunately, I think it's false optimism. I think that had Hillary Clinton won, I think we'd already be in a recession. And I think the reason that we're not is because people are convinced that maybe things are going to get better, that we're going to cut taxes, get rid of regulations, and we're going to have a lot of economic growth. But I think people are overlooking an enormous problem that is actually getting worse. And I think once this false confidence wears off and people start being a little bit more realistic, I think we're still headed to recession. Maybe it's going to happen a year later, but this is going to be a big problem for the stock market. It's going to be a problem for the dollar. Meanwhile, look at commodities. Oil hit a new high today, new 2-year high. I think that's the beginning of a trend.
All right, so speaking of being realistic, though, realistically, if someone was bearish over the last 9 years or so, they missed out on a huge opportunity to make a whole lot of money. How does someone who's anxious about this market still reconcile the need to make money in a market that is going up?
Yeah, well, I mean, I got a lot of money in emerging markets, and they're actually outperforming the U.S. market this year. So the U.S. market is not the only market that's going up. Now, I will concede that I would have been better off had I invested in U.S. stocks in 2013, 14, and 15. Those were years where the U.S. did a lot better than the markets that I'm in. But since the beginning of last year, we've been able to beat the U.S. stock market. But I think that we're early on in the bull markets in some of these foreign markets. Again, as I said, commodities, I think, are just beginning new bull markets.
Before I let you go, give me the yellow/red flag that the average investor should be looking for, though, that maybe it's time to exit.
Look, well, I think if you look at the amount of complacency relative to the overvaluation, stocks have really never been this expensive, and people have never been this sure that they're not going to go down.
Using what metric?
Well, if you look at like the CAPE for valuations, but then adjusted by the VIX, and look at the fact that people are not concerned at all. And believe me, the U.S. economy today has bigger problems than it had in 2007 before the financial crisis.
Though, that people aren't, there's not irrational exuberance out there. People aren't going in bars and watching stock on TV. You know, in other words, the average person out there, a lot of them still not even in this market.
Well, the average person is broke. I mean, part-time bartending, you can't really get into the stock market. But I say there is a lot of irrational exuberance among professional investors, people that are managing money for a living. I mean,
Peter, we got to let you go, buddy.
Okay.
I'm going to bring you back more often. I love hearing your point of view, and I appreciate you coming in.